In this video, we're going to look at the basic layout of a statement of financial position, or otherwise known as the balance sheet. In order to look at the statement of financial position, you got to understand it's done on a specific day. In this case, the 30th of June. So you got to have the business name there, the name of the statement, and on a specific day. A balance sheet or statement of financial position is almost like taking a photo of your business to see how does your assets, owner's equity, and liabilities play out. Now, a balance sheet is based on the accounting equation, and it's very important to understand that it's only these accounts that appear in here. No expenses, no revenues or income, as those are used in your statement of profit or loss. Now, the most common accounting equation is known as assets are equal to owner's equity plus liabilities. You can obviously also say owner's equity equal to asset minus liabilities, or liabilities are equal to assets minus owner's equity. The layout of my statement today is going to be assets minus liabilities equals owner's equity. Now, you can also do that layout in two different ways. You can firstly add up all your assets and then subtract all your liabilities. However, I'm going to do it this way. I'm going to start off with my current assets. Now, the definition of a current asset, remember, it's an asset already in cash form or will be converted into cash within 12 months. So I'll start off with my current assets, and there you see cash or cash at bank. Lots of people have a category called cash. That could include petty cash, cash at bank, and even savings accounts. All right, so that's my cash. I then get to accounts receivable. Now, why is accounts receivable a current asset? Because this is already in monetary form, and hopefully your debtors, your accounts receivable, will pay you back within 12 months. We then go less provision for doubtful debts. So there is my accounts receivable, less provision for doubtful debts, and I put my answer in the second column. Now remember to draw a line when you do a calculation. I then come to inventories, and if you look at my layout, you can see that's already cash. This is in cash form. This still has to be converted into cash. So that's why I have my layout like that. It's very liquid layout. Inventories, current asset, because you try and sell this within 12 months. So there's my inventories amount. And then you have accrued revenues, in other words, money, revenues owed to you on the last day of the financial year, or prepaid expenses. In other words, expenses you've paid in this year, but it's only applicable for the period starting 1 July 2009. So those are all my assets. I add them up, draw a line, and I put it in the third column. I come to less current liabilities. Current liabilities are those liabilities that you want to get rid of first. The government, in other words, the GST clearing, is one of the things you want to get rid of first. If you had a bank overdraft, you would have that under current liabilities, and also on top here because of the high interest that you will pay on a bank overdraft. There are my other current liabilities: accounts payable, accrued expenses, unearned revenues. I put them in the second column, add them all up, draw a line, and put that in my third column. Now I say current assets less current liabilities gives me my working capital. And now, as I said, remember the layout: assets minus liability equals owner's equity. I've done current assets, I've done current liabilities. Now I come to my non-current assets, also known as fixed assets. Right, so if we look at this, we start off with investments. And that is fixed deposits or term deposits, government bonds that you bought, debentures that you bought. Remember, debenture is basically another business borrows money from you, or shares. In other words, you as a business bought shares in another company. Those are all assets to you under investments. Then we get to our fixed assets, the property, plant, and equipment. And what do we do here? We have vehicles at cost price, the value, less the cumulative depreciation. In other words, depreciation written off over the time period that we had these vehicles. and you will go there, the cost price of vehicles less accumulative depreciation, put the answer in the second column. As you can see, I've drawn a line again, calculation took place. The same with office furniture, the same with equipment. You then subtract the accumulative depreciation, and a business could also have land or buildings under property and plant. So now if we just move up, we come to another form of non-current assets. That's intangibles. In other words, assets, possessions that you have that you cannot touch. Copyright, that is one where you have registered the copyright of this. If you, for example, are an artist and you write a song and somebody uses a snippet of your song, then you could get royalties from that. Patents, in other words, you invent a construction or design of something and you put a patent on it. Nobody else can use it unless they pay you. Trademark, for example, the Nike trademark, that right tick that you get normally if you've done something right, that will have TM or R in a circle because it means it's registered. That is an intangible asset to you. That Nike sign is worth millions to them. So there are all my non-current assets in black. I've put it in and I've put the totals in the third column. And now I go investments plus property, plant and equipment plus intangibles. That gives me my totals that I'm going to use to subtract my non-current liabilities. Here I have examples of a mortgage and a loan. Very quickly, a loan is something you're going to hopefully pay off within 1 or 2 years. A mortgage payment is normally, if you buy property, you get 20, 25 or 30 years. So that's why these two won't be necessarily undercurrent liabilities. However, you could say the next year's payments of a mortgage or the next year's payment of the loan that I'm going to pay in the next financial year, that part could sometimes be shown under current liabilities. Remember the definition? Current liability is debt that you owe that you want to pay off in the next 12 months. The balance of the mortgage and the loan will then still appear here. But for our case, we're just going to keep the total mortgage and loans there. And so now I take all these amounts in black, and I say less non-current liabilities, and that gives me my net assets, right? So we look at these amounts, we add them all up, less the non-current liabilities gives me my net assets. Now, if you look at there, I have done assets minus liability. Now, that's got to be equal to owner's equity. You will then go to owner's equity. And remember, owner's equity is capital at the beginning of the period, plus the net profit. If the business made a loss, it will be less net profit, and you will subtract it. I draw a line. Now, you could have also put that in the first column and the answer in the second column. That's not that important. But now you also go, whatever the answer is you got, you subtract the drawings during the year, and that answer should be equal. In other words, that means my assets minus liabilities should be equal to my owner's equity.